Tasuki pattern is a trend confirmation configuration where the market gives a continuation signal after an unfilled gap. So before we dive into what the Tasuki pattern is, it's crucial to understand what the gaps are and how the gaps are formed in the market. Now let's first understand what the gaps are. So a gap is a discontinuation, or let's say a hole between two consecutive closing prices, mainly caused by low liquidity. For example, let's say the market is closed at 100 rupees, but now on the next day it getting opened at rupees 102, right? So there is a gap between the closing price of yesterday and the open price of today. So this is the gap. So this bullish gap, and then if you see, we are missing 101 rupees, right? So let me give you an example now. So this is your bullish gap and this is your bullish gap, right? And how this is formed, I'll show you that. Now for an example, let's say the previous candle got closed, or let's say yesterday the market closed at rupees 100, right? And this is your closing price, this is your open price. Now this was yesterday, and then today the market opened at 102. So this is your opening price of rupees 102. Now there is a gap. If you see, the market opened without touching rupees 101. So this is a gap, and we normally call it bullish gap. Now the gap can be formed because of many reasons. It could be the fundamental reason, or let's say the technical reason, and they are more common in certain markets. Let's say in the equity market it's very much common compared to the others, like the currencies, or let's say the forex. Now let's try to understand how many types of gaps are there. So basically there are four types of gaps. We have common gaps, we have breakaway gaps, we have runway gaps, and then the exhaustion gap. Let's go through them one by one. So this is a common gap. Now, so common gaps, also known as the trading gaps, or let's say area gaps, so they typically occur in the sideways market, and generally they are filled quickly. Now let's try to understand the characteristics of a common gap, or let's say the trading gap. Now like I said, it occurs in the sideways market, so we can say there is always a range bound between the gaps. So when I say the range bound, if you see over here, let me show you. So this is your gap, right? So this is your gap, and then this gap is normally this gap happens normally in the sideways market. I'm sorry for my drawing, but yeah, cope up with that. Okay, so like I said, it happens in the sideways market, so it always goes round, or let's say it's in the range. Since it's a sideways market, or since it happens in the sideways market, the volume is normally on the lower side, because you do not see much volume whenever the market is in the range bound, and then it gets filled within few days or sometimes even hours. But if we are working on the forex, or let's say the currency market, we don't wait for like the couple of days, we work on the hourly basis. So normally these kind of gaps gets closed very fast. Now since they occur in the non-trending market, it's not very common to find such kind of gaps now, and the price is likely to get filled up very soon, like I said in my previous point. Now let's talk about the breakaway gaps. The breakaway gaps normally happens like its name. It happens when the price breaks out of, let's say, a consolidation point, or let's say out of the resistance or the support level, right? So suppose in the previous video, in the previous slide, we saw that there's a range bound up and low, or let's say there was a range. So the same happens with the breakaway gaps, but what happens over here, it normally goes, so this is, I would say, it's a breakaway gap, right? Breakaway gap. Now this happens normally, like I said, it goes above the support level or the resistance level. It breaks through the support level or the resistance level, which basically tells us that there is a beginning of a new trend. Now since it happens above the resistance level, or let's say the support level, the volume normally used to be high. So whenever there is a price break, or let's say a support or resistance break, it has to happen with the volume or surge in the volume. So we can say that it happens during that time. Now again, since this happens because of the breakout, or let's say the break point, these gaps do not get filled very easily, because if I show you, so when this has happened, the volume was high. Sorry for this over here, but since the volume is really high over here, and the gap, if you see, do not get filled. I mean, why? Because it happened because of the price break, right? So it's really very rare that the market is getting filled, or let's say the gap is getting filled. Now let's go to the third point, which is the runway gap. Now if you have noticed, first we went through the common gaps, then we went through the breakaway gaps, and then now we are on the runway gaps. Now if you have noticed, there is a pattern, right? first it went on the consolidation level, right? So first it was, let's say this was resistance and this was support, right? Now first it was on the sideway or the consolidation, then it broke out of the resistance, right? And then which was our breakaway, this was our, let's say, the common gap. And now we are talking about the runway gap. So runway gap, basically it's a third step, or let's say the third phase, wherein it gives you a confirmation about the continuation of the trend. Now if you notice over here, there is a small gap over here, right? So this is a gap. Now what this basically tells you that, and this happens most of the time in between a continuation of the market, or let's say, yeah, of the trend. So this gap is basically gives you a confirmation that there is a continuation of the trend which is already going. And this is some, I would say, where the traders used to take the chance and then buy the stock, or they place the order. But one thing that you need to make sure that the volume is high. If the volume is not high, then I would not recommend to go, because volume is one of the basic indicator, I would say, to go with any kind of strategy, not only the Tasuki strategy or pattern, but any strategy. Volume is one of the parameters that you should always consider. So this was your runway gaps. Now the last but not the least is the exhaustion gap. So like I said, first we went through the common gap, then runway gap, then breakaway gaps, then runway gaps, and then the exhaustion gap. So with the name itself, we can say why is it called exhaustion, because this happens normally when there is a change in the trend, right? So when I say change in the trend, if you notice over here, there is a gap over here, right? So this is a gap, and then it starts with the sell signal of, let's say, high volume of the sell. Now this normally happens when the price has went on the breakout, but then it gets reversed, and this normally, and then there's a chance that this kind of, let's say, the gaps are generally filling the gaps if they have happened in the past. Now if you see, there was a trend, right? There was a good trend, and then there was a breakout as well from the resistance level, but then from here it again came down, like there was a high selling pressure, and here the market started to fall down. Now that we have understood what the gaps are and how the gaps are formed in the market, now it's the time to go back to what the Tasuki pattern is, right? So let's go. So we have two types of pattern in Tasuki. One, we have bullish pattern, and then we have the bearish pattern, right? So first let's go to the bullish pattern. So in the bullish Tasuki pattern, the first pattern, or let's say the first candle, of course it's when the name itself tells it's a bullish candle or it's a green candle. And then after that, the next candle which is formed above the bullish candle that we had, but again this was the first candle, right? This is the second candle. Now this second candle is again formed as a bullish candle, but there is a gap. So where is, if you notice over here, this is the gap that we have, right? So this gap is formed in the Tasuki pattern. Now sorry for my drawing, but yeah, this is how it is, right? So this gap, so the second candle forms with the gap between the first and the second pattern, or let's say the second candle. Now the most important part is the third candle. The third candle is normally used to be a bearish candle, but the main point here is this bearish candle do not closes below the first candle. So there is always a gap of, let's say, the closing of the bearish or the third candle and the first candle, right? So this is what the Tasuki pattern is. Now let's go to the bearish pattern, a bearish Tasuki pattern. Now in the bearish Tasuki pattern, again the format, or let's say the flow, is the same. So first we have one bearish candle, right? And then again there is a second candle which is formed with a gap between the first and the second candle, right? So this is a gap. Now the third candle, which is generally the gap, the bullish candle. Now this candle is formed just above the second closing candle, or let's say the bearish candle, but it will not cross the first bearish candle, right? So there is always a gap between the first candle formed and the third candle formed. So this is what the bearish Tasuki pattern is. Like I said, this does not happen very frequently in the currencies market, but yeah, this is very much, this is very common in the stock market, or let's say the derivatives or equity market. See, the intuition behind the Tasuki pattern relates to the breakout principle, where the price breaks out from a certain, let's say, threshold, let it be the resistance or the support level, and then it gives you a confirmation about the continuation of the trend, but then after a brief pullback, right? So, but one thing that you need to make sure, or let's say you have to take care, is not to use the Tasuki pattern as a whole, as the only pattern that with which you can take the trade. So always make sure that you use the volume, that which is really important. If you have seen, the gaps that are formed is majorly based on the volume level, right? And then always use as one or two more indicators just to get the confirmation. Let's say MACD is there, RSI is there, which basically gives you the confirmation whether the market is still in the continuation pattern or not. And then again, like every video that I'm used to mention, always make sure to use or to have the risk management strategy in place, right? So always have risk to reward ratio 1:2 at least, so that if you are risking your 1 rupee, you should at least get 2 rupee in return. Otherwise, don't, I mean, there are like hundreds or thousands of stocks available in the market, so why you should go behind something which is not giving you confirmation, right? Now this is with the theoretical part. Now let's go back to the coding part. I will only show you the chart, but like I said, in the currencies market, it's really not possible to find a Tasuki pattern. The pattern is really, I mean, it's very rare. And then in my analysis, it appeared only like 31 times in the last 10 years for the Euro USD pair. So you can relate how rare it is, right? So it's not easy to basically test and let's say to do the back testing of such kind of patterns. But I will share the code. I will show you what I have done, and then maybe you can try your own on other currencies, right, or pairs, or maybe in the stock market. But since this is a Metatrader that I'm using, so I'm using only the currencies. Okay, so we will be following the same pattern, or let's say the same coding strategy, or let's say the coding pattern that we have been doing. So this is what the code is. So first we will be importing all those libraries which are required, which is like date time, and then the time zone, pandas, Metatrader 5, which is really important, NumPy, Matplotlib. Then we have initializing the Metatrader 5 software with the help of passing the username and the password, and then the demo account. Now again, we have the multiple frames, or let's say the time frames. I will be using the hourly time frame because in currencies you cannot be working with, let's say, on the daily basis or the day data, right? Now we have the list of assets, then we have the code. So yeah, this is the code, or let's say, yeah, if the initialization is not done, so it will give you error. And this is a time zone. This is the from date to date, so I have taken only one date. I mean, see, I'm not going very detailedly because I have done this like many times now. I think this is the 5th video in the series, and in many videos I have already gone through like many times what each and every line does. So please, I would request to go through that rather than expecting me to go through the line by line with each video, right? So now the mass import. So this is basically what we are doing, getting codes. So D1 is a daily data, and then H1 is a hourly. So I will pass on these parameters in the future function, let's say, or upcoming function. So basically, yeah, this is a mass import. So basically this is fetching the data. So this is the index number 1, and then the hourly frame index, let's say, yeah, frame. Adding column. So basically the adding column is done so that we can create a couple of more columns for the buy and sell signal, right? So this is the signal, and then these are the candles that are being created. Rounding is done. Again, please go through my previous video, please. I'm really sorry. So this is the chart, and then yeah, so this is how it is formed. It will not show you the buy or sell signal, not because there is no code, but because of course there is a code for the buy and signal, but like I said, it's very rare. This pattern itself is very rare. Now what did I miss? The logic behind it. I'm really sorry, I forgot the logic. So let me share the logic. I do not want to go through the logic of the code, but what I will do, let me paste the logic because I've already gone through the logic with the graph. Yeah, so this is the one. So I'll just paste the logic over, sorry. So this is the logic. I'll just comment it, and then please go through the logic. I will also share the logic and the code on my website, which will be there in the description, right? Now let's talk about the key takeaways what we went through. So the key pattern is a 3 candlestick pattern, which we have already seen. So it works both on the bullish as well as the bearish market. And then what we did, we went through the types of gaps that are formed or that are the base for the Tasuki pattern. So there were like 4 types of gaps, and then we went through the algorithmic logic behind how the candles, or let's say this pattern, is formed. Now last but not the least, since this pattern is very rare, it's very important that even if you see any this kind of pattern in the market, please make sure to use one or more indicators so that it gives you a confirmation that whether the decision that you are about to make is correct or not, right? So thank you so much. Thank you for watching this video. It's a long video, but if you find this video useful, knowledgeable, or it has increased your skill, please like, share and subscribe to The Data Scientist for more trading insights, algorithmic trading, and the signals to buy or sell the stocks. Now, if you have any questions, please leave it in the comment sections. I will surely reply on that. And then we will see you in the next video. Thank you so much. Take care, eat healthy and drink plenty of water. Bye.